Hi, this is Ferre with TaxSaleSupport.com with another video in our Tax Sale Fundamentals series. So for this video, I wanted to talk about a very important topic if you are involved with real estate at all, and especially if you're looking at tax sales, and that is foreclosure. I wanted to talk about foreclosure in general, but we need to define exactly what it is that we're talking about. And it's an important concept to understand completely. So let's first define exactly what foreclosure is in the way that we're using it here. And I looked at different definitions online, but a lot of them were talking about things like a mortgage and stuff like that. And the reality of it is that doesn't necessarily have to be involved. Really, what foreclosure is simply the legal process through which property ownership rights are removed due to some kind of an unpaid debt. Okay, so it is the legal process you go through in order to take property away from somebody that is not paying for it, essentially, when it comes to property taxes. Now, I think it's important to understand beyond that the specific mechanics of how it works. So, for let's say, for the sake of simplicity, we have a foreclosing party. Okay, that have that looking like the county government. We could say it's some kind of government entity there. Either way, it's the foreclosing party, and we have the property up here on the top right that's being foreclosed on. Let's say that the individual hasn't paid their property taxes in a long time, something like that. So it has by the legal qualifications, it can be foreclosed on at this point. So what exactly is it that happens, and what is this process of foreclosure? Well, really, what the process is about is notifying the parties that may have a financial interest in the property about the impending foreclosure. It's about giving people the proper amount of notification and the right time frame to basically respond to that foreclosure notice, and to be able to prove that that notice was sent to those parties is essentially what the state laws dictate. So for the foreclosing party, what that would really mean is they would look at they would probably do a title search on the property itself, on this property they're foreclosing on, to see who the parties are that have a financial interest in the property. What they would do at that point is they would prepare foreclosure notices, which would state the amount that was owed and the foreclosure date. Uh, and they would prepare one of these for each party that has some kind of an interest in the property. So let's say that there are a couple other parties that are involved with this property that have an interest in the property. Let's say that one of them is the lender, okay, because let's say there's some kind of a mortgage on the property. And the second one is a cosigner, you could say. So there are a couple of people, and sometimes people have second mortgages out. There can be lots of different people that can be on the list of people with interest in a property. But we'll say in this case that we've just got the cosigner, the lender, and then you've got the home owner or the buyer, essentially the borrower. Okay. So when those foreclosure notices go out, they're going to go out to each one of those parties. That's going to include the homeowner, the cosigner, and the lender. Now, for the cosigner and the lender, they may not even be aware that this property has a delinquent amount owed against it before this. Okay, it may be unknown to them, but the idea is to get that foreclosure notice to them so that they can protect their interest in the property and ultimately pay the bill. That's what the intention is when you go through this process, is to try to give somebody every opportunity and chance to keep the property and to avoid having it go through foreclosure, because the way that the laws are written, they do try to build in a lot of protections for property owners. And so that's essentially kind of how the foreclosure process works. Although we need to define a couple of things here now that we kind of have those basics. there are two types of foreclosure. Okay, there is what's called the judicial foreclosure, and there is a non-judicial foreclosure. Now, the power to actually foreclose on real estate is something that's granted in state laws. It's a part of state laws because it is a part of property taxation and enforcement. So, in the same way that they're very specific about the laws and when it comes to their rights to tax the people, they're also very specific when it comes to the laws regarding removing property from a person as well. But it's ultimately an enforcement method. But yeah, that non-judicial is the second kind. So what's the difference between the two? Well, first thing we need to understand here is that foreclosure laws are like property taxation laws. They are unique to each state. So every state has its own set of laws, and every state has laws that dictate and control how foreclosure is executed, what the time periods are, everything related to that. So they have all of those requirements listed in state laws. So this is going to include um, what the duration of that foreclosure period is. Who has to receive the foreclosure notices, how the notices need to be sent. Um, it will also describe what can survive the foreclosure process or exactly how that works, because not every state is the same. And it also covers all of the stipulations if for redemption. So if the person's able to come up with the money to redeem, then they cover that as well. So that's part of the reason why it can be somewhat confusing for people, is because there are so many different ways that it can be done. Now, most of them are similar in different aspects, but there are some differences between the types. Now, a foreclosure that follows state laws, okay, that goes through uh, the state laws and follows everything legally according to the time frame, the way the notices are supposed to be sent, all of that. Uh, those types of foreclosures are generally done through the courts. They're what you would call a judicial foreclosure. And a judicial foreclosure is essentially the most powerful foreclosure that a property can go through. And that's because a judicial foreclosure, through the courts, it's actually wiping out and extinguishing attachments to that property or encumbrances that are there because of this first position lien and the nature of property taxes. So, judicial foreclosure is, for us as investors, it's a great thing because we can appreciate the power of that foreclosure to wipe out things that are attached to the property. We can appreciate what that does. In fact, if you had the choice to buy a property that had just been through the foreclosure process versus one that hadn't, you would always be better off going with the one that had just been through the foreclosure process, because all that can really do is just extinguish, different encumbrances or liens attached to the property that might not, that might still be there otherwise, if you were buying it without it going through the foreclosure process. Now, non-judicial foreclosures are what we would also call or refer to as bank foreclosures. Okay, sometimes you'll see them as lender foreclosures. And what we're talking about there is a completely different type of foreclosure altogether, because this is about the foreclosure by businesses, by lenders on with borrowers. Okay, so this is where you're talking about the people that suddenly lose their house quickly to the mortgage company. Bank foreclosures are totally different from standard judicial foreclosures, and here's why. The bank would argue that uh, they can't deal with the same time frames that a standard judicial foreclosure requires, because they would lose too much money. And the reality for the bank as well is that they're still on the title. In fact, the ownership of the property doesn't actually get completely transferred over to the owner until they've paid it off completely. So the lender is still on that title. But if the borrower fails to make their payments, then part of what they agree to when they sign the mortgage contract stipulates what they have to do as far as their end of the agreement, what they have to pay. But it also, there's a part in that called a power of sale stipulation. And what essentially is happening is the borrower is signing away their right to a judicial foreclosure when they fill out that mortgage contract and sign it. So by signing that, they basically give the lender, the power to execute their own type of foreclosure on the property, which generally takes place in a much shorter time frame, and it doesn't actually go through a true foreclosure when we consider foreclosure judicially. It's not like that. It doesn't actually go through that foreclosure. It's just simply the lender, removing the ownership rights from the borrower. Now, one of the reasons why it's important to understand foreclosures is because it's related to a couple of these key points. And the first one is, do you know why tax sales are the cheapest way to buy real estate? This is something that you'll hear Steve and I say on a pretty regular basis because we know it's true. Hands down, tax sales are the cheapest way to buy real estate. You can't find anything cheaper, it's not out there. Um, Another question here is, do you know why you'll always find better deals on judicial foreclosures than you will on bank foreclosures? Because I can guarantee you, you will never find the kind of opportunity that you can find with a judicial foreclosure in a bank foreclosure. It just doesn't happen. And uh, you can look at foreclosure sale after foreclosure sale, and you'll see that that's the case. Well, the reason for that is fairly simple. Okay, the county has no personal interest in the selling price of the property. It does not matter to them at all because they don't consider any of that theirs. The only thing that the county cares about is the amount that's owed to them. And they essentially make that the opening bid amount. So if the property gets any kind of a bid, then it's automatically reached that amount, and they are happy to sell the property because it means they're able to collect the money that's owed to them, which is their first priority. Now, really, when you go to a tax sale where you're buying these properties that have been judicially foreclosed on by the county, there generally isn't going to be any kind of limitation on the price. Nobody's going to make you pay more for that property besides competition, essentially. In some cases, states have laws that are written. There are some states that have laws that require counties to sell properties for a certain percentage of assessed value, but we generally stay away from some of those states. Most of the states that we talk about and work in don't have that type of a problem. Now, really, what that means is that you are the only thing that really can hold you back when it comes to the prices, or they can bring up the prices, is the amount of competition that you're dealing with. And beyond that, there are plenty of ways you can get involved with tax sales that have no competition. So, you can buy through over-the-counter tax deeds, let's say, and the opening bid amount is essentially the amount that you pay for the property. There is no competition there. So there are some incredible opportunities there to buy property for a ridiculously low price. That'll never happen with a bank foreclosure. And the reason for that is because the bank is ultimately still the owner of the property. And they may offer the property at a slight discount to try to get a new owner into it. But that discount will be nothing like you'll find with tax sales. And that's because they're willing to give up a little bit of profit, but they're not going to give up that much profit because it's still money out of their pocket. So that's why you'll never see the same kind of a deal with a bank foreclosure as you will with a tax sale, with a judicial foreclosure. The county is 100% honest when it comes to their collection of money. And so they'll take that extra money and set it on the books. They won't do anything with it. It's basically leave it there for the property owner to to claim. So that's why tax sales are such an incredible deal. It's because you have these thousands of counties across the United States that foreclose on properties, and that when they do this, ultimately all they want are the delinquent taxes that are owed. There's an incredible opportunity there. Now, while we're talking about judicial foreclosure, something that's also important to understand is that there are actually two different types of judicial foreclosure, depending on the state that you're dealing with. There's what's called a self-executing foreclosure and a non-self-executing foreclosure. Now, this is important to understand because what they're describing here is who is responsible for executing the foreclosure. Now, in self-executing states, or states that utilize a self-executing foreclosure, and by the way, you can find out about these things in our state guides as far as which states do which. But a state that uses a self-executing foreclosure system, it basically means that the county handles everything related to the foreclosure process. So let's say that you buy a lien in that state, and the end of that redemption period comes up for the lien, and the lien needs to be foreclosed on. Well, in a state that has a self-executing foreclosure, what that means is that you essentially only need to probably fill out a form or notify the county that you are ready to begin pursuing that process. In other words, you just kind of have to give them the go ahead, and then they will go through the process of uh, getting the foreclosure notices up and sent out, properly to all the parties of interest. Um, so, as you can imagine, self-executing foreclosure is a real advantage when it comes to not needing to go through the foreclosure process and having the bank or somebody else do that for you. Sorry, the having the county do that for you. Now, non-self-executing foreclosure is where the responsibility for the foreclosure is on the lien holder, to execute. And if this is the case, then really what it means in most cases, if you're dealing with a state like this, then what you should probably plan on is just hiring a real estate attorney to help you complete that process. If you account for that in your investment, it's not a big deal, and it will probably save you a headache. The headache of trying to figure it out on your own. There for the first time, it'd be a lot easier, I think, to just hire it out. But you can look at different states. Florida, for instance, is a self-executing foreclosure state, meaning that when you buy a lien there, the county are the ones to go through the foreclosure process on it. But in Florida, they also will offer that property up at a tax deed sale, and essentially, if the property sells at auction, then they'll use the proceeds from that to pay off all of the lien holders. If it doesn't get a bid, then the lien holder, will get the property. So there's still a high degree of security there, but they put an additional layer in there that guarantees, or at least it increases the chances of it just redeeming. So yeah, as you're looking around at different states to invest in, these are things to think about and to consider and to find out about the state before you get heavily involved or before you buy anything. Certainly, you need to understand exactly how the foreclosure process works in that state so that you can make good investment decisions, and so that you don't basically get into something that you don't fully understand. That's easy to do as long as you're willing to read up on these states beforehand. So. Um, Thank you for watching the video. If you're new to tax sale support, uh, myself and Swenson, if you're new to all of that and you would like to download a free ebook, you can go to secretsoftaxlieninvesting.com to download that ebook, which is a fantastic ebook. You can also go to our members website, which is taxsalesupport.com, if you'd like to check that out. So thanks for watching the video, and remember to subscribe.